All right, welcome everybody. This is Chapter 5. We're going to be moving into accounting for merchandising operations. And the difference, what we've done so far in this semester is we've dealt with service companies, right? Companies that are selling their services, consulting services, lawyers, people that are selling services but not products. And basically what service organizations do is they sell their time in order to earn revenue, and their income statement, one of the financial statements that we've learned already, right, is basically revenues minus expenses equals income, right? Your net income amount is your revenues minus expenses. And for a service company, that's basically what it looks like. There'll be, of course, a lot of expense accounts, couple revenue accounts at most, but basically nothing else in there. One of the key differences that a merchandising company is going to have is, of course, well, first of all, their revenue is called sales. It's the exact same thing. I just want you to think that a merchandiser's revenue is called a sales account, but it's treated the exact same way. And rather than just the expenses being subtracted out of the revenues, merchandisers have one very large expense, which is the cost of goods sold. And the reason is because they, of course, sell goods, not just their own time. So they're going to have one very large expense called cost of goods sold. And if we look at this, I want to compare the two side by side, a service company versus a merchandising company here. You'll see a service company just has its revenues, which a merchandiser also has, called sales. Except the merchandiser has this very large expense, and it usually will be one of the largest expenses that a merchandiser have. And merchandisers, we're talking about things like Apple Company, Samsung, Android, all those things, even Best Buy retail merchandisers, all sorts of different things that have a very large expense called cost of goods sold. This gross profit box that you see in this example here is really just a subtotal, right? When you take your revenue minus your cost of goods sold, that is your gross profit before you start subtracting out all your other expenses. But really no other difference other than what we call the revenue and this very large cost of goods sold here, which we're going to start working with now, the concept of what cost of goods sold is and how we calculate it. So different kind of merchandising companies, just so that we know a little bit of background. Of course, a manufacturer is a company that creates products, right? Takes some sort of raw materials and creates another good with it, some sort of improved product. A consumer is on the other end. That's what you and I are, right? But there's other consumers. Companies can act as consumers as well. And then there's everything in between, right? There's wholesalers and retailers generally who are much higher up in the chain, and that's really who we're going to be dealing with in the next two chapters. Both Chapter 5 and Chapter 6 are wholesalers and retailers. Manufacturers we don't deal with until managerial accounting, which may be next semester for you guys. So we're going to be dealing with wholesalers and retailers for the most part. And there's two main functions and two main challenges, I guess, that accounting for merchandising companies creates for us. And this is, by the way, your first handout for today. There are two handouts for Chapter 5 posted, and this is the first one, and the very next slide we're going to get to is your second handout. So be sure to check those out on Web Campus and save them and possibly print them out if you prefer to do that. But I've broken up the chapter into two main functions, of course. There's some challenges in recording and properly accounting for purchases of the goods that we're going to sell, and of course the selling of the goods we're going to sell. So we're going to start with section number 1 here, where we are acting as a retailing company that is purchasing the goods that we're going to sell and how to account for them. Next we'll get into the sales stuff. This is the second slide that you guys are going to be dealing with, and this colorful scheme here is really just a graphical representation of a very simple concept and simple algebra problem that we've got here, and I want to give you a very simple example. It describes all inventory systems. First of all, inventory is the goods that we buy that we're going to sell. That's what we call it in accounting. Now, inventory can be very easily summed up with this representation. And what it means is if we have beginning inventory, let's say we have $2 worth of inventory, right? In our beginning inventory. That's what we started the period out with. And we go and purchase, let's say, another $8 worth of inventory. If you add those two up, you will get what these things are pointing to, the total merchandise inventory that is available for sale during the period. We had $2 worth to start with. We went and bought another $8 worth. Well, the total we will have available is, of course, $10 worth of inventory. Now let's carry that forward. If we have $10 worth of inventory, and then at the end of the period I go and count, hey, there's only $1 left of inventory in my ending inventory count, well, that means we must have sold $9 worth of inventory, right? That's all this is a very simple algebra equation represented graphically. I want you to keep this handy. This is an important slide, and it'll mean a lot to us both in Chapter 5 and Chapter 6. And even in next semester, it'll mean a whole heck of a lot. So get comfortable with this and understand what it means. This will help you on part 1 of the homework, by the way, as well. They're going to ask for total available for sale. And the very simple way to calculate that is take your beginning inventory plus whatever you add, the purchases that are made during the period. By the way, if we stick with that same example, we had $10 worth of inventory available for sale during the period. And I know that I sold, let's say, $4 worth. Well, we know that, or we expect in ending inventory to be $6 worth. Hopefully this is a fairly simple concept. I think it is, but spend some time with it and understand it, and honestly keep this handout next to you when you're doing homework. All this is based on one of the main things that accounting for inventory or merchandise inventory is based on the cost principle. We learned this back in Chapter 1, which I know is a long time ago, 3 weeks ago, and the summer seems like forever. But a very simple concept. Remember that our accounting information is based on cost. Not what it's worth, not an intrinsic value, not what some appraiser would appraise it at, but whatever it cost us. If it cost us $2, then we have something with a value of $2 as far as we are concerned. It's really called a cost basis of $2. So let's go ahead and take an example here. Let's say our company that we work for, we're the accountants for, is Z-Mart, okay? And we're going to go purchase some inventory. By the way, you're going to hear these terms interchangeably, merchandise inventory or just inventory or merchandise. It all means the same thing. Things that we are purchasing that we are going to then sell. And that's what we're in the business of doing. Buying these things and selling them. They are called inventory or merchandise inventory to us. So, let's assume that on November 2nd, Z-Mart purchased $1,200 of merchandise inventory for cash. Let's go ahead and analyze this and prepare the journal entry. Remember, the way I like to think of it is first, is cash involved? Here we know it is. And is our company's cash going up or down as a result of this? Correct. Of course it's going down, right? We're giving $1,200 cash and we're getting inventory for it. And I'm giving away a clue there. We're going to be debiting our cash account to show a reduction in that asset, and we're getting another asset called merchandise inventory in exchange for it. So we're going to be debiting the merchandise inventory asset account. That's what it looks like in journal entry form. One asset is going down, another one is going up. And this is the first time you've seen this merchandise inventory account, of course. It's a new asset account, but it's treated just like any other asset account. It's got a normal debit balance. To show an increase in the merchandise inventory account, we debit it. To show a decrease, we credit it. And keep in mind here, of course, we're spending cash, but there's no expense yet, right? Because we haven't used up that $1,200. We've just exchanged it for a different asset. Now we own inventory with a cost basis of $1,200, which will give us some sort of a benefit in the future, right? The very definition of an asset. Something that we own that will give us a benefit in the future. The benefit is, of course, we can sell it for cash at some time. One of the things I want to discuss now is what looks like French or Japanese or some other language that we don't know. You're going to see in the chapter are terms like these. These are called credit terms. And by the way, we don't see these on a day-to-day basis, even though we use credit cards, but that's not what we're talking about when we're talking about credit for businesses. If you're a merchandiser like Walmart, let's say, and you are purchasing tons of goods from different suppliers, Walmart probably doesn't cut checks or have their driver whip out a credit card, right? Their suppliers simply just send a bill every month to Walmart, for example. But they sometimes between suppliers and different merchandising companies, they will extend credit terms, and they do this in order to incentivize people to pay them sooner. In other words, and I want you to understand what these credit terms mean. You're going to see them in your chapter, and I don't want you to freak out when you see them. I want to give you a real simple explanation of what they mean and how to read them. So the first term you're going to see, the number before this backslash, is the discount percent that the person will get or the company will get if they pay within this next term, number of days, right? So in this case, it would be 2% discount if you pay us within 10 days, right? Then you're going to see a comma and the letter N, which means net, or the total is due within 30 days. So in other words, if we saw these credit terms, if we were Walmart purchasing agent, right, and we went out and bought a whole lot of goods and our supplier said, look, I'm going to sell you $100,000 worth of merchandise. I'm going to put it on your account. The total amount is due in 30 days, but if you pay me within 10 days, you can take 2% off. And when we're talking about large amounts, that 2% or some small percentage can mean a very large discount amount. So I want you to learn how to read these. You're going to see them in the chapter. Hopefully this is a very simple explanation. I think I concisely do it in what the book takes a couple of pages to do in very confusing pages, but really nothing to it. I want to give you a little bit of practice here. So the first one we saw, if paid within 10 days, we could take 2% off. Otherwise, the total amount is due within 30 days of the invoice. And by the way, it's always by the date of the invoice. Key terms. I'll ask you that both in quizzes, exams, and in homework. That's the date to keep an eye on. Here's another one to practice. What do these credit terms mean? I'll give you a couple seconds, and then I'll give you the answer. All right, here's what it means is obviously credit has been extended, but if the creditee pays within 15 days, they can take 5% off. If not, the total amount is due within 60 days. And again, the 15 days and 60 days are based off invoice date. So the total amount is absolutely due 60 days from invoice date, but if we pay within 15 days from the invoice date, then 5% discount can be applied to the total amount. That's what it looks like there. One more example, give it a quick shot. I'll give you guys 15 seconds to figure this one out. All right, what it means is, of course, if it is paid within 10 days of the invoice date, we can take 3% off the total amount. Otherwise, the total amount is due within 45 days of the invoice. Fairly simple, looks a little foreign when you first see it, but really not much to it. So let's jump back into an example here. And let's say on November 2nd, instead of buying in cash, Z-Mart, our company, purchased $1,200 of merchandise inventory on account. And the credit terms, meaning our supplier, said, hey, here's the terms I'll give you. You can go ahead and buy this on account. You don't have to pay me now. It's due in 30 days, but if you pay soon, within 10 days, you can take 2% off. That's what those terms mean. And we do it, of course, to incentivize people to pay in advance so that we don't have to chase them, don't have to put them into collections, and we keep the cash flows coming, right? Real important. So that's what those terms mean. Now, what I want you to think about, and this is a little bit of a trick question, but I'm going to throw a hint in there for you. I want you to analyze this transaction and see what the journal entry would look like. And I throw in a big hint. Credit terms don't affect the initial journal entry, right? Because what are we doing here? All we're doing is buying inventory, once again, for $1,200. $1,200. We're not paying it now. We're going to pay later. And of course, we learned that paying our supplier later is simply accounts payable. The credit terms don't come into effect until we pay that amount off, right? So all we're doing is debiting our merchandise inventory to show that our inventory has increased by $1,200 and crediting our accounts payable account to show that we owe that supplier $1,200. Whether the discount applies depends on when we pay it back. And we'll take up with this example right when we start the next video.